Welcome back to our channel. In our last video, we talked about the importance of normalizing rent when valuing a business, making sure that the rent that appears on your business's financials reflects market level rents, so that buyers can accurately understand your business's true profitability. In this video, I'm going to relate to you two true stories from our files that show just how critical this step is. One story ends with happy owners, the other in a disaster. Let's start with the good one. Years ago, we helped a client buy a service business. After the purchase, we continued advising her on a consulting basis. Her business was producing handsome profits, so at one point we suggested that she buy a nearby building and lease it to her business. And because she was doing so well, we suggested that she charge her business an above-market rental rate. Not grievously so, but marginally so, 20%, maybe 25% above market. This strategy pulled some of the profits out of the business, lowering the business's taxable revenue and its owner's tax liability, and into the real estate, where those profits are treated more favorably by the tax authorities. This also allowed her to keep more of her earnings. Now, this, of course, raised her business's expenses and thus lowered her business's profit. And for the duration of this period, her business valuation was lowered. But this was meaningless until and unless she wanted to sell. So here's what we did. We made sure that when she eventually decided to sell, she knew that we would have to again normalize the rent, adjust it back to market levels. We advised her that when the time came, she should prepare a new lease, one that reflected market level rent, so that the business's true earnings power was evident to any buyers. And that's exactly what happened. When she decided to sell, the buyer understood the story, the new lease was clean, the numbers made sense, and everybody walked away happy. That's what happens when you plan properly and understand how rent impacts valuation. Now let's contrast that story with a very different one, the disaster. This one involved a restaurant with about $1.2 million in revenue, a straightforward valuation and sale, or so it should have been. Now, though we met with the sellers very early on and explained the selling process, what we do and how we do it, they decided to go in a different direction. In doing so, they made three major mistakes that turned what should have been a simple, profitable sale into a disaster. Mistake number one, they hired a large regional CPA firm, 15 staff members, 8 partners, multiple offices to value the business. Now, nothing wrong with CPAs, but this wasn't a tax job. It was a valuation. And though the firm did valuations, they focused on businesses with $100 million in revenue, completely irrelevant to our situation. A professional business broker with a CBI certification could have done the job for 1/10 the price that the CPA charged, and would have done a better job because they had a better understanding of the business and the market it was in. But in the CPA's defense, we found little to quibble with in their methodologies. The second mistake that the sellers made is they separately hired a real estate appraiser to value the property, but never told the appraiser that the appraisal was to support the sale of the business. Now, naturally, the appraiser approached this as if the tenant, the business, was paying market level rent. In fact, the business was paying rent at about 40% below market value, a fact the appraiser was never told. This single oversight meant that the appraiser's number was completely wrong, more than $300,000 too high. And the third mistake the sellers made, they hired a real estate agent, not a business broker, to handle the sale. Now, the agent didn't know how to analyze the financials, nor how to reconcile the two valuations. So she just added them together and said, oh, it adds up to $1.25 million. Let's go with it. Well, high fives all around, and 2 weeks later we see that it's up on the MLS for $1.25 million. The only problem is that the numbers didn't make sense. If the restaurant was paying 40% below market value rent, then three things were true. One, the business wasn't generating enough income to support market rent and therefore might simply be unsustainable. Two, the business value established by the CPA firm was significantly overstated because it was based on the below market rent the business was paying, and its expenses were unrealistically low and profit therefore unrealistically high. And third, the real estate, based on the rent actually being paid, was substantially overvalued. When you correct those numbers, the true combined value of the real estate and the business, it wasn't $1.25 million. It was closer to $800,000, a difference of more than $400,000. Now, many of you know that our tagline is every business that doesn't fail will sell. Every one, eventually. But it'll only sell when the reasons it didn't sell to begin with are corrected. After 12 months of no activity, we got the call. It took us 5 minutes with the CPA's numbers and the appraiser's report to see the problem. But no one involved wanted to face the solution. So the real estate agent soldiered on, wasting everybody's time and money. But as with every business, this business eventually did sell. But it took 15 months and happened only after the unhappy couple accepted an offer of $770,000 just to get rid of it. A total of 27 months to sell this business. Now, the lesson here is simple, but it's also one that many buyers or many sellers overlook. And that is your rent, no matter whether it's too high or too low, has a direct, measurable impact on your business's valuation and its likely sale. Normalize it. Document it. Make sure that the person, whoever's valuing or selling your business, understands how to account for the rent. Because in the end, you could have a great business, but if the numbers don't match up, if they don't work out, it just won't sell. In our next video, we describe how to handle inventory when transferring a business, so don't forget to subscribe so you don't miss that one or our subsequent videos. In the description box below, you'll find links to various resources, including our series on how to determine a business's worth, whether you're buying one or selling one, as well as to courses, consulting, coaching, etc. So if you found this helpful, hit the like button, subscribe, and in the meantime, I hope you stay healthy, and I'll see you on our next video.